Vanakkam, Namaste, and a very warm welcome to everyone joining us this morning from India, and a very good evening to those of you tuning in from the US. We are delighted to have you with us for this exclusive webinar on Indian taxation for NRIs in the US, proudly hosted by us in association with HDFC Life. As you all know, taxation laws between two countries can be complex with a lot of amendments coming day in and day out. Today, we have with us one of the finest experts in the field, Mr. Ajay Vaswani, who has helped many NRIs handle Indian taxation regulation easily. Before we move into the core session, I would love to introduce Ms. Vaswani, Head of NRI Wealth Plus at Integrated, to share a brief overview of how we support our NRI clients to tailored investment solutions. Over to you, Ms. Vaswani.
Thank you, Mr. Shubha. Good evening, all. Thank you so much for joining us in this session, in spite of your weekend plans. Integrated's NRI vertical, built on 50 years of trust and serving thousands of NRIs across the globe. Led by Ms. Bharati Bhaskar, our program director, this vertical is thoughtfully designed to blend expertise with a human touch. With 172 branches across India, including 75 in Tamil Nadu, our team is always accessible just a call away. Whether you are building your retirement corpus back home or planning to repatriate the funds to the US, we have got tailored solutions for you. We offer parent care services for your loved ones in India, tie-ups with leading hospitals like Apollo, Kaveri, Medway, and health insurance with the copay concept, retirement planning, and income tax filing. We keep you always connected with India's financial landscape through your regular updates and curated webinars with industry experts. Our Gift City offerings allow investments and redemptions in the US dollars and even healthcare solutions coverage with worldwide. Yes, we have been on the ground in the US hosting 6 international events at places like Austin, Texas, San Francisco, San Diego, Cleveland, and our upcoming events are at Raleigh, New Jersey, Francisco, and Dallas. We have initiated this session on taxation, listening to your needs and responding with care. Thank you once again for coming over here. Over to Mrs. Shubha.
Thank you, Vasumati. It is my privilege to introduce our distinguished speaker for the evening, CA Ajay R. Vaswani, an expert in NRI taxation and FEMA regulations. Mr. is a fellow chartered accountant from the Institute of Chartered Accountants of exclusively to assist clients from over 20 plus countries across the globe. His specialization includes residential status, handling real estate transactions, managing income tax scrutiny notices, or facilitating remittances from India. Today's session is structured in a way that with detailed presentation by Mr. Ajay, followed by Q&A session at the end. Please post your queries in the chat box. And today it is even more special because it is also Mr. Ajay's birthday. On behalf of all of us at Integrated and HDFC Life and everyone attending today's session, we wish you a very happy birthday, sir. Wishing you a great year ahead with good health and prosperity. Please join me in welcoming once again CA Ajay R. Vaswani. Sir, the virtual stage is all yours. You can share your screen.
Thank you so much, Team Integrated, and thank you, Team HDFC, for two things, of course. One, for the warm wishes extended on my birthday, and second, requesting me to deliver this session. So it's been 13 years now. I've been into NRI taxation, and I've been exclusively into this. And the passion for this subject is so much. The moment I got an invite, I could not say no to this even on a birthday morning. So thank you so much. And I'll just share my screen, and only one presenter can share at a time. So replace current share. Okay, just a second. Okay. Can you see my screen? Can you? Okay. And my audio is very clear?
Yes, sir. Paka.
Okay, thank you so much. I welcome you all to this session, India Taxation for NRIs in US. This would be a tentative 60-minute non-stop session I would be doing. I request all the participants to put the Q&A, whatever you have, in the chat box. In the fag end of the session, we would be taking up all the questions all together. And while we go through, I would tell you by end of the session, you will be able to address at least 50 plus FAQs that you come on a regular basis. These are the key agenda items that I have highlighted. These all things would be covered in the today's presentation. Okay, so you can take a note of it, and line by line, I would be covering all these items for you. And very important part is, it is very important because a non-compliance in India for a non-resident Indian would directly lead to the penalties, which are very high comparatively. So ignorance is not a bliss, it is a cost for you. It is important that you stay updated with the rules and regulations. What is important for you, what is to be done is very important. Okay, so the objective here is today to share knowledge on this subject. There is two rule books. One is income tax, another is FEMA, which primarily governs the non-resident Indians. I would like to create an awareness over there and eventually help you wherever you want, considering the compliance perspective. Okay, so as I mentioned, there are two rule books for a non-resident Indian. One is Income Tax Act, which defines your residential status and taxability of the income. This is our revenue law, and which is purely ascertained on the basis of number of days you have stayed in India. Whereas the second rule book, which is FEMA, that is Foreign Exchange Management Act, this is more of a regulatory law. This is more of a compliance law, which tells you as a non-resident Indian which bank accounts you can have, what investments you can do, how the money can be remitted. And unlike the income tax, this is more of a intention based. So we are not seeing the number of days you stay in India or stay outside India for the purpose of definition of an NRI as per the FEMA. So mind you, there are two different definitions. The NRI definition as per income tax is different. NRI definition as per FEMA is different. In FEMA, what we see is only the intention. So if you are an employment outside India, on the day one itself, see, your intention is not that you are coming back to India. Your intention is to continue in the foreign country and not immediately come back to India. What you might be doing is you might be just coming to India for a visit purpose. So that is not included in this intention. On the day one itself, you are a non-resident Indian as per the FEMA perspective. And that is where it is said that your saving account needs to be mandatorily converted into NRO. You need to update your KYC as a non-resident Indian in your demat account. So these are all are prescribed under the FEMA, and this is checked on every possible date when you intend to do a transaction in India. So our session more today is about the income tax. We will speak more on the income tax, but in the meantime, I will cover whatever important points are there for the FEMA perspective. First of all, let us understand who is a non-resident in India. What you need to see, since all of you are a non-resident Indian, you come to India only for the visit purpose. What you have to see is your stay in India should not exceed 183 days. If it is being fulfilled, you are a non-resident Indian. Second thing, if you see, a lot of times people ask me, Ajay, what is RNOR? What are the tax advantages we get? So in India, income tax classifies an individual on two grounds. Either you are a resident of India or you are a non-resident of India. In the resident category, there are two sub-classification. Either you can be an ordinary resident or you can be a not ordinary resident. Who qualifies to be non-resident Indian? Resident but not ordinary resident, that is RNOR. You have to see two things. Number one, are you a non-resident in India in 9 out of 10 years, or your stay in India is less than 729 days in last 7 years? If you fulfill any one of the condition, you are eligible to be called yourself as RNOR. The advantage of RNOR is whatever is your continuing foreign income, you don't pay any taxes in India. So today, if you are an NRI, you are looking forward to come back to India, and if you fulfill any of the condition, at least 2 years you get an advantage that whatever foreign income you have, India will not tax the same. So that is a migration phase benefit available to returning NRIs, that your foreign income is not taxable in India. If we see as a income perspective, see, you are NRI, you are earning outside India, You have surplus funds, you have saving funds, which eventually you invest in India. You might be doing some deposits, insurance plans you are investing upon, or maybe you are putting the money into real estate or shares or mutual fund. So some of the other income would be coming. So if there is an income coming in India, that is where the taxation also comes into picture. As a NRI, you have two types of income. One would be an Indian income and one would be a foreign income. Irrespective of your residential status, you be resident, you be RNOR, you be NRI, Indian income is always taxable for you. Okay, this is point number one. Second thing, foreign income is exempt if you are NRI or RNOR. It is eventually when you become resident of India, that is resident and ordinary resident, that is the time when your foreign income also starts to be taxable in India. At times also people ask me that, okay, Ajay, I am working in US, I am transferring these many funds to India. Would I have to pay any tax on that? So income tax in India doesn't puts any taxes on a mere occasion that it is a transfer of an income which is earned outside India to India. On the principal sum, whatever you are remitting to India, there would be no taxation. However, the income that you generate over the same, over that investment would be an Indian income, and eventually that would be taxable. You need to understand what is the criteria for an income to be taxed in India. So there are two rule books that we see. If anyone gives a thumbs up, it becomes a taxable income in India. So one is if your place of accrual of the income is India. Second, if your place of receipt of income is India. If any one condition is fulfilled, it becomes your Indian income. So every time you have an income, you need to ask, is that income accrued in India or income received in India? If yes, then this is certainly your Indian income, and the Indian revenue authorities have the right to levy taxation on the same. Primarily, for an individual, there are 5 major heads of income. For the purpose of classification, income tax gives you 5 heads of income. What are those? Number one is salary. Second is business and profession. These two heads are not really very important for the NRIs because you don't have a salary income in India, and very few actually have a business or profession income in India. But the next 3 heads, which is house property, which covers your rental income, there is capital gain. These are very important. I am sure all the NRIs joining here today would have either house property income or capital gain. And whatever is not classified in these four major heads is put into other sources. So like your interest income, your LIC investments, apart from that PPF. So all these subcategories of income are put into other sources. Let us talk more about the capital gain and the house property. That is where the lot of questions also come in, and then we will go upon the taxation of other things together. So if you see, capital gain are primarily from two type of assets. One would be an immovable asset, which is your flat, apartment, villa, land, something. So which is fixed to the nature, that is immovable asset. And second is movable assets, which are liquidable assets like your mutual fund, your equity, your stocks. So these are movable assets. What you have to see is, before getting into the taxation, there is a concept which we need to understand, is called as period of holding. Why this is important? Because if it is a long-term capital gain in nature, the government gives you an incentive by reducing the tax rate. So every time we have to see, first we see the period of holding, and then we see the what is the tax rate applicable. Second thing what you need to note here is, India taxes the capital gain only when the asset is realized. So unlike in US, you pay taxes even on the unrealized income. It is not the scenario. Only when you have hold of the asset, that is when the capital gain come into picture, and that is when you eventually have to pay for the taxes. Let us understand how does the taxability works for a movable asset. So first category being the most uh, seen for is your equity, your stocks, your equity oriented mutual funds, REITs, or even for that matter PMS. Here the concept of period of holding that you see is 12 months. So if you have been holding the asset for more than 12 months and then selling it off, it is classified as long-term capital gain. Whatever is the gain value, on that you have to pay 12.5% tax. Government gives you incentive here. First 1,25,000 of the long-term capital gain would be exempt for tax. Any income over and above that would be taxable at a rate of 12.5%. However, if you are selling the stock or any other investment in the same criteria in a period which is less than 12 months, short-term capital gain tax rate comes into picture, and that rate of tax is 20%. there is a very important pitfall that you need to understand over here. If you are a non-resident Indian, if you have a capital gain, to give you an example, if you have a total capital gain of long-term capital gain of rupees 2 lakh, so first 1,25,000 would be exempt. On the balance 75,000, you end up paying flat 12.5% tax, even if you don't have any other income or your income is below the exemption limit. So this is one very big difference between a taxation of a non-resident and resident. So today, if I am a resident Indian, I don't have any other income, and I just have this 2 lakh rupees of income. First 1,25,000 is exempt, balance is 75, which is very much below the basic exemption limit. If I'm going for a new regime, it is 4 lakh. If it is below the exemption limit, I don't pay any taxes as a resident. However, for a non-resident Indian, we don't see the basic exemption limit. This is a flat tax that you have to pay. On 75,000, you end up paying 12.5% tax. The second category is a debt mutual fund, where more than 65% investment is into debt funds. So irrespective of the period of holding, this is always taxable as per the slab rates. Then there are listed bonds and debenture. Here the period of holding is again 12 months. Short term is slab rate. Long term is 12.5. And the same is for unlisted share, but just the difference is period of holding goes to 24 months. The maximum changes around the capital gain taxation came in the budget 2024. It was in July 24 when the Honorable Finance Minister presented with the budget. The entire structure of the capital gain was rationalized to structure in a way there are just two tax rates, either 12.5% or 20%. And if not, then it goes to the slab rates. And that is where you saw major change also coming in. Everyone read about indexation being done away with. So indexation had a very good role play when you were calculating capital gain or sale of a immovable property. So let us see what were the rules and regulations before the budget, and then we will discuss what are the new amendments and how does has affected a non-resident Indian. If you are seeing to calculate the capital gain on sale of an immovable property, here also the period of holding concept is seen, and here the period of holding is 2 years. That means if you are selling the asset after holding it for 2 years, this is classified as long-term capital gain. And if the transaction, if you have sold the property before 22nd July, you used to get the benefit of indexation. So your original purchase price is brought to the present value using the cost inflation index, and using that purchase price that is inflated as per the indexation and the sale value, whatever is the difference, that was your chargeable long-term capital gain. On that you had to pay 20% tax, and short-term, that is less than 2 years, it was always slab rates. The change that had happened over here is the concept of indexation was done away. So on 23rd July, when the finance minister presented with the budget, they said that concept of indexation is done away with for everyone, and whatever is the difference in the purchase price and the sale price would be treated as your capital gain. On that you end up paying flat 12.5% tax. However, after a week, when the bill was presented in the parliament, there was an amendment, there was a clarification made that indexation will be available to the residents. So what it means is, if you are a resident of India, as per the income tax, you have both the options to choose for. Either you go for an old regime where you take the indexation and pay 20% tax, or without indexation, you pay 12.5% tax. Wherever your tax liability is less, you can opt for that, but only when you are a resident of India. For an individual who is a non-resident Indian, they don't have the benefit of indexation. It is just the difference in the sale value, less expenses incurred exclusively for such transfer, like maybe you are paying brokerage or a commission to an agent, or legal fees on transfer, less the cost of acquisition, less the cost of improvement. That is how you calculate your capital gain. On that net value, whatever is your actual gain, you will pay 12.5% tax if you're selling a property after 23rd July 2024. For a property which was bought before 1/4/2001, maybe your parents bought the property in 1980, 1990, and you got it through inheritance, you're selling it right now. So in this scenario, what we do is we have to calculate the fair market value of the property, also known as a ready reckoner rate, as on 1/4/2001, and the value as on 1/4/2001 is considered as the base purchase price for the purpose of calculation of the capital gain. So this was the cost inflation index. This is nothing but a multiplying factor issued by the government year on year. And So primarily all long-term capital gain are subject to taxes. Government gives you an incentive based on the reinvestment opportunity. There are three sections which govern the reinvestment exemption for the NRI. It is 54, 54 EC and 54 F. So 54 and 54 EC talks about capital gain arising from sale of a residential property. When I say residential property, it means a place where you can live upon. Whereas section 54F, which is capital gain arising from any asset which is other than residential property. So any property which is like commercial property, shop, or a vacant land, or for that matter, mutual fund or shares would be governed under section 54F. Let us understand section by section how are the implications and what benefit you get. So section 54 says you will have to reinvest the capital gain amount into a new residential house to claim for the exemption. So for example, if I bought a property for 1 crore, I am selling it for 3 crore. 2 crore is my long-term capital gain. Section 54 requires me that this 2 crore should be reinvested into another residential property, and for which timeline is also specified. Okay. So it should be either 2 years from the date of sale that you buy a new property, or in case you have bought a property in last 1 year from the date of sale, that is also allowed for the purpose of claiming the exemption under section 54. In case you are buying a land and constructing a house on that, so in that scenario, timeline is extended to 3 years because construction will be taking time. So minus 1 year plus 2 year if it is a ready to move in property, or if you are buying a land and constructing a house yourself on that, in that scenario, timeline is 3 years. Whatever new property you are buying should be under lock-in. You cannot exit from the same in 3 years. However, in case considering the investment amount is big, there are too many options available, which property you want to buy, it needs that identification and getting on the terms and conditions also. If your reinvestment decision is being postponed by the due date of filing ITR, you have to open a designated bank account in a PSU bank called as capital gain saving account. Put this gain money into this designated bank account, and while filing ITR, you can claim for the exemption. And whenever you are decided, okay, I want to buy this property, what you can do is use this designated bank account to pay off the developer or the seller as the case may be. The next section is 54 EC. Again, it is about capital gain coming from a sale of a residential property. But this is for someone who is not looking to invest into residential property. Government gives you an alternative where you can put the money into the specified bonds. So bonds are like NHAI, REC or HUDCO. So HUDCO is the recent one which is announced. What you can do is you can invest a maximum of rupees 50 lakh per annum per person into this and claim for the exemption. And this investment is to be done within 6 months from the date of sale. And of course, there is a lock-in. It is a 5-year lock-in product. Whatever interest you get, tentatively it is 5.75% now. So this interest what you get is also taxable. And third section being 54F, which is talking about any other long-term capital asset. Here the big difference is earlier in 54 and 54 EC, we were investing the capital gain money. Okay, only the gain amount was being reinvested. Here the entire sale proceed is to be invested. So for example, if I'm selling a land and the same value, like 1 crore was my purchase price and 3 crore is my sale value. So 2 crore is my capital gain. To claim exemption in 54F, I need to invest the entire 3 crore in buying a new residential house. And the restriction, more or less the conditions are same, timeline is same, lock-in is same, capital gain account features are same. One exception over here is, in case you already have 2 residential property in your name, you are not eligible to claim for 54F. So this is one condition which restricts for the benefit to be claimed if you are going for a section 54 exemption. Okay. Let us understand what are the different TDS rates and how you can see the taxability of that. So first, let's see the interest income. Whatever interest you income. So before that, I tell you what is TDS. TDS is tax deducted at source. This is a mechanism where the government says we want the regular cash flow to come in to take care of the expenditures. For a non-resident Indian, whatever is the highest possible tax rate, which will also be the TDS rate for you. So for example, interest income. Interest income is taxable as per the slab rates. But in this scenario, what is the highest tax rate? You are in a 30% category. So TDS rate is also mentioned as 30%. So whatever interest you get on your NRO deposits, TDS would be deducted at 30%, but income tax that you would be paying would be as per the slab rate. So it is but obvious it is always on a higher rate that TDS is being deducted. You file your ITR, you will always claim a refund on that. Same is for the rental income. 30% TDS is taxes on as per the slab rates. Long-term capital gain, I mentioned it is tax rate is 12.5%, TDS rate is also 12.5. However, first 1,25,000 is exempt. So on that TDS, you can claim as a refund. Short term and dividend, there is no benefit as such. Dividend for NRI is taxable at 20%. This is again another pitfall which is very important for you to note. Any individual who is a resident of India, for him, dividend income is taxable as per the slab rates. For an individual who is non-resident, it is taxable at a flat rate of 20%, and that is why your TDS is also deducted at 20%. This is very important to note. I have seen a lot of people filing their ITR and declaring and paying taxes as per the slab rates, which is wrong. Tomorrow, income tax department can come back to you and ask for the differential or the short payment of the taxes. Now let us talk about the TDS on the immovable property. This is again a very important slide, and this impacts a lot of non-resident Indians. Let us see what are the rules for the resident first, and then we will come on the non-resident part. So any individual who is a resident of India who is selling a property in India for a value which is more than 50 lakh, on his sale value, buyer would be deducting TDS at a rate of 1% and paying to the government by filing a Form 26QB, which is a PAN-based form. So tomorrow you see yourself, like if you are buying a property from any developer or an individual in India who is a resident for value which is more than 50 lakh. So to give you an example, you are buying a property for 1 crore. So eventually what will happen is you will pay 99 lakh to the seller and 1% of 1 crore, which is 1 lakh rupee, to the government on his behalf. So this compliance is on your part to be done, and you are required to file for a 26QB, and based on that he will be taking credit for that 1% TDS. Now, but if you're selling the same property as a non-resident Indian, there is a major change. What does government says? TDS rate would be again at a rate on which eventually you have to pay taxes. Now, irrespective of the sale value, rate of TDS would be the tax rate on which you pay tax. So if you are selling a property before 23rd July, tax rate was 20% with indexation, so TDS rate was also 20%. Now that tax rate has been reduced to 12.5%, TDS rate will also be 12.5%, but this is not on the gain, this is on the sale value. And for this, buyer has to get the TAN number, that is TDS deduction number, and file for a 27Q form, which is a TDS return. This provides for a issue for a non-resident Indian for the very basic reason that taxes that he would be paying on the capital gain is on the net gain that he has. Okay, tax you pay on the capital gain, TDS you always pay on the sale value. So it will always be that your TDS is deducted at a higher rate and your money is stuck with the government. But still there is an opportunity available. Let us understand what are the two practical scenarios for you. Number one, but obviously you would be claiming it as a refund. So if I take this illustration where your sale value is 1 crore and your cost of acquisition is 90 lakh. So eventually what is your capital gain? Chargeable capital gain is rupees 10 lakh. On this, your tax liability is 12.5%, plus there is a surcharge of 15% on this, and education cess of 4%, making it effective tax rate of 14.95%. So what is your tax liability to the government on this transaction is 14.95% on a capital gain of 10 lakh, which is eventually 1,49,000. But since you are NRI, buyer would be deducting 14.95% TDS on a sale value of 1 crore, which will be eventually 14,95,000. You file your ITR, whatever is the excess TDS, government will be paying you back. And in this example, it is 13,46,000. But what if you are selling the property in today, June 25? ITR would be filed in June, July 26. Considering amount on a higher side, government can take any time between 1 to 3 months for the refund to be processed. So what is happening in this scenario is your money, your principal money is being stuck with the government for a period not less than 12 to 18 months. And this can cause you inconvenience. So what does government says? In case you don't want this and you want your TDS to be equivalent to your tax liability, you can apply for a lower TDS certificate. There is a form 13 which is called, and this is to be made to your concerned jurisdictional income tax officer. Once you have identified the buyer, you need to submit the required details and the documents explaining the computation of income along with all your KYC and the property documents, and tell them, see, my tax liability is just 1,49,000 on a sale value of 1 crore. On being satisfied, they will issue you a lower TDS certificate which will be equivalent to your tax liability. So in this example, your lower TDS certificate will come at 1.49%. You give the same to the buyer. Based on that, he would deduct the TDS at the same rate. And in this scenario, there is no question of excess TDS being withholded or paid to the government. Okay. So next head of income is house property. Though it is said house property, but this includes getting a rental income from any kind of an asset. Any immovable property you have, it would be covered under the income from house property. So primarily, whatever income you get from the rental receipts is taxable as per the slab rates. India has a progressive slab rate. Next chart will be coming up, which will be showing the tax rates in India. Again, I have already mentioned TDS is to be deducted at a rate of 30% plus 4% education cess. So this is a compliance on the tenant. If he is not deducting TDS, you need not worry, but you need to educate your tenant that I am a non-resident Indian and you should be deducting 31.2% on that. Further, you get the two deductions on that. Number one would be for the municipal taxes. If you are paying the municipal taxes on the actual basis in that financial year, you are allowed to take for the deduction for that. And also considering that you have a house property, you would be spending some money over the repair and maintenance of that. Government says we will give you a standard deduction of 30%, irrespective of the fact that you are doing or not doing the expenditure. Or maybe for that reason, your expenditure is less or more, doesn't matter. We will give you a flat deduction of 30% of your total rental receipts. Only the net 70% becomes part of your taxable income. You also get the benefit if you have taken any home loan and you are going for an old regime. So you get the interest benefit deduction of till 2 lakh and principal of 1,50,000 under the ATC. Next topic is deemed rental income. This is also very important. It says maximum number of residential houses that you can have for your self occupation is 2. In case you are having more than 2 house property and see you say that it is self occupied, government will treat any property over and about 2 as deemed let out. You have to calculate the fair market value of the rent that you can get by holding that property for you. Okay. Coming to the double tax avoidance agreement benefits, there are primary 4 benefits you get. So number one is the interest income that you get in India. So like covering your NRO interest, it is chargeable as per the slab rates. Otherwise, TDS is 30%. I have already told you. If you are taking the benefit of double tax avoidance agreement between India and US, tax that you pay on the interest income in India is 15% in that scenario. And of course, this is a chargeable income in US. You can claim for the foreign tax credit. Second, I told you dividend is flat 20%. If you're taking the advantage under double tax avoidance agreement, this is reduced to 15%. Capital gain, there is no change. India retains the right. However, in US also, this is taxable because US comes under the global taxation bracket. Whatever taxes you are paying in India, US will give you the credit for that. And similarly is for the rental income, there is no as such advantage if you are going for DTAA. So primarily you have two just advantage. One is on the interest and second on the dividend, where you can reduce your tax liability in India. However, your global income is taxable in US. You will have to pay for the foreign, you will have the credit for the foreign taxes paid in US. Okay. Coming to the point, what if you have a taxable Indian income during the previous year? It is mandatory that you have a PAN card. Nowadays, everyone seems to have the PAN card available, and it is mandatory that you file your ITR in India. So coming to the slab rates I was talking, so India has a progressive slab rate. On the left side of the screen, you will see the old regime. So that is where you get the benefit of the ATC. till 2.5 lakh, you don't pay any taxes, and then 2.5 to 5%, 5 to 10, 20%. When your income goes over and above 10 lakh, you pay 30% tax. The central part you see is the tax rate for financial year 24-25. Now is the time due for filing ITR in India for financial year 24-25. In this scenario, you don't pay any taxes till 3 lakh, 3 to 7, 7 to 10. And like when you exceed 15 lakh, you go in the 30% bracket. And the rightmost column you see is the budget 25 amendments. These are applicable for financial year 25-26. That is the current year. The ITR for which would be filed in the next year. Okay. So for this particular year in India, you will not pay any taxes if you are opting for a new regime for an income up to rupees 4 lakh. Every additional 4 lakh, there is increase in the percentage of tax at a rate of 5%. And when your income exceeds 24 lakh, you pay tax at a rate of 30%. If you just compare the new regime for financial year 24-25 and 25-26, eventually government has given you a benefit of INR 1,10,000 as an incentive or as a change on a year-on-year basis. Lot of WhatsApp group you would have seen that you will have to not pay any taxes for an income which is 12 lakh. That is only for the resident individuals. They get the rebate. NRIs are not getting the benefit of the rebate. And for you, as per the new regime, financial year 25-26, 4 lakh is only the basic exemption. Whatever is your tax liability, there is an additional surcharge you pay as per your income liability. And there is an additional surcharge, education cess of 4%. I also added to that. The next is, this is also very important. This is important for the very reason that you can plan for your capital gain or carry forward of losses. So government says, in case you have a loss from these particular head of income, and wherever I have written yes, you can set it off against that particular head of income. So for example, if you have a loss from a long-term capital gain asset like mutual fund or shares, you can set it off against an income you have from any other long-term capital gain. And whatever losses are not set off within the same financial year, you can carry forward up to 8 years, provided you file your ITR before the due date. And this you can carry forward up to 8 years. So tomorrow, if you have any long-term capital gain, the brought forward loss would be set off and balance will only be part of your taxable income. Okay. So these are the conditions which make it mandatory for you to file ITR in India. Number one is, of course, if your income is over and above the basic exemption limit. If you are opting for old regime, it is 2,50,000. If you are opting for new regime, financial year 24-25, it is 3 lakh rupees. If you have a capital gain, in the earlier slide, I told you it is a flat tax that you have to pay. So if you have even short-term capital gain of rupees 10,000, you have to pay rupees 2,000 on that as a tax, and it is mandatory for you to file ITR in India. Dividend income is a flat tax, 20%. If you have dividend income, it is important that you have to pay taxes, and it is mandatory that you have to file ITR also in India. Lot of NRIs under the misconception that TDS has already been deducted. We have paid for the taxes, and we are not required to do any other compliance. So that is not the scenario. The ultimate compliance that government expects from you is filing of the income tax return. That is where you declare your residential status and your total income and your total tax liability to the government. Third benefit is, of course, if you want to carry forward the loss up to 8 years, you need to file your ITR before the due date. And then there are a few more conditions which make it mandatory for you to file ITR in India. So like if your TDS is or TCS is there for more than 25,000, you will have to required to be file ITR in India. And then all these expenses and deposits are with the India perspective. So if you are spending more than rupees 2 lakh on a foreign travel from an NRO bank account, it is mandatory for you to file ITR. If you are paying electricity bill in India for more than 1 lakh, it is important. And then current and saving account deposits are there. Okay. So what is the due date? If I talk about financial year 24-25, primary due date is 31st July. However, as we speak, as on date, the utility or the ITR forms to be filed have not yet been released, and the government has come up with an extension with themselves that due date to file ITR for financial year 24-25 is now extended to 15th September 2025. So this is the primary due date for this year now. Otherwise, it is always 31st July. And in case you miss upon the primary due date, you have an opportunity to file a belated return, which is up to 31st December, subject to a penalty, which is either rupees 1,000 or 5,000, depending upon your total income, with certain disadvantages. Disadvantages being you cannot carry forward the loss if you're filing a belated return. Second, you cannot file for a revised income tax return if you see any mistake and if you have filed a belated return. So unlike if you are filing a primary income tax return and you see any mistake in that, you can file for the revision n number of times. Okay, so I said you can file ITR in India only for 1 year at a time. Government has come up with another opportunity for people who have missed filing their income tax return. So earlier it was 2 years, budget 25 has extended it to 4 years. So you can file ITR U is for updated return for past 4 years now. Conditions being it should not be a return of a loss, it should not reduce your tax liability, and it should not result in a refund claim. So primarily you cannot claim as a refund in case your TDS was deducted and you want to claim it now. You cannot do that. And of course, there would be an additional penalty and an interest component to that, which is percentage basis. So if you missed filing your ITR for say financial year 23-24, the additional tax that you have to pay would be 25% of your tax liability. So for example, your tax liability comes to rupees 10,000. So you will end up paying rupees 12,500. Similarly, 20 to 23, it is 50%. 3 year you go back, it is 60%. 4 year you go back, it would be 70%. Now the question comes in, why you should be doing this? For the very reason that since it was mandatory for you to file ITR in India, you had a tax liability, you have missed upon the same. So tomorrow if income tax department comes to know there was a tax liability, they would be sending you a demand notice with the penalty which goes up to 200% of the income that you have escaped. So it is always advisable for you to file ITRU, and like just for 1 year if I talk first year. So you can end up paying 25% and file your ITR and not come under the penalty of 200%. So eventually you will save on your penalties if you are filing for an ITRU. Okay. So coming to the non-voluntary part, should you still be filing ITR in India if you don't have any taxable Indian income? So government says it is mandatory for you to file ITR in India only when you have a taxable Indian income. This is a question I am putting to everyone. Should you be filing tax return in India in case you don't have any taxable Indian income? My answer is yes. And these are the advantages that I have identified. These are very important for you, and specifically because income tax return in India is the only document which number one substantiates your residential status to the government. This is voluntary. You are filing with the government that see, I am a non-resident Indian. I am based out of so and so country. Second, it will substantiate your sources of income in India. And third, also this document proves as a NRI status document for you. Second benefit is if you don't have any taxable Indian income, it is but obvious you don't have to pay any taxes on that. So you get one document which substantiates your residential status, your sources of income at a no cost. So you get one document which says you are a tax compliant citizen of the country. So I don't see any harm in that. Third, as I mentioned, TDS is always at a higher rate for an NRI. You file your ITR in India, 99.99% of the time I have seen a non-resident getting a refund, and range I tell you, it is anywhere between rupees 20,000 to 2 lakh rupees also. So it is very important for you to log into your tax portal, check your 26A statement. That is where the TDS summary is updated. That is where you will get to know what are your sources of income and what is the TDS that has been deducted. It also brings enhancement to your financial eligibility for any loan or visa processing. So tomorrow, if you come back to India, you become resident, you apply for a loan. First document any banker would ask you is an income tax return copy. So it would be a practical thing. If you have not been filing, so you would be stuck with the eligibility of the loan. It helps you in the assessment. So income tax department can go back for 10, 6 or 3 years. These are on differentiate basis. So when there is any tax assessment happening, income tax return plays a pivotal role in explaining your residential status and the sources of income to the government of India. And last benefit I have already told you, you can carry forward of losses for future set of up to 8 years. So at times people ask me that, Ajay, we are a non-resident Indian. It is mandatory for us to show the foreign income and foreign assets while we are filing ITR in India. So answer is, it is not compulsory for you. If you are an NRI, what is important for you is only to declare the Indian income. However, if you become resident of India and you have continuing foreign income and foreign asset, it is mandatory for you to disclose your foreign assets and pay tax on your foreign income in India. Coming to the bank account part, so primarily as a non-resident Indian, you can have two types of bank account, and third one is a deposit, which is FCNR. FEMA requires you that you convert all your resident saving bank account into non-resident ordinary account. The non-compliance penalty for this is penalty up to the 3 times the amount that has been involved in your NRO account, or rupees 5,000 per day. So penalties are extreme. However, of late we have not seen RBI coming down heavily on the NRIs for non-compliance of this, but this is always advisable that you convert your saving account to NRO, and in addition you get a benefit of opening NRE account, that is non-resident external account, under the same customer ID with the bank. You should always have NRO and NRE preferably in the same bank. And the advantages being that NRE, whatever interest you get is exempt from taxes. You don't pay any tax on the NRE interest. NRO income, being the Indian income, is always subject to taxes. And on that, TDS is also there. People do ask me that, Ajay, can we remit the funds if I have sold any property in India? The primary money would be coming to my NRO. I have a provident fund matured. I have LIC policy matured. I have some money available in India which I earned while I was in India. Can I remit it to a foreign country? So answer is yes. As a non-resident Indian, you can remit up to 1 million USD per annum per person, subject to the compliance that number one, tax is paid on that. You need a form 15CA, which is an income tax form, and 15CB, which is a chartered accountant certificate. You take these two documents to the bank, these two certificates. Bank will give you one A2 form. You fill up that. Based on that, you can move the money from your NRO account to NRE, or from your NRO to your foreign bank account. This is just the last slide, and then we will take up the questions from you. So in case you have a PAN card which you took as a resident Indian, and then you have a Aadhaar card also. So Aadhaar card is not mandatory for NRI, but a lot of people I see have taken the Aadhaar for the sake of convenience. It is mandatory that you link your PAN and Aadhaar. If you have not linked, your PAN would already been made inoperative. So request you to log in and check what is the status of your PAN card. It is important that it is made operative. Second, gift received rupees more than 50,000 from non-relative becomes taxable in your hands. So this is very important, that maybe you will have friends coming into the foreign country and visiting you and requesting you for some forex, and they will say that, okay, I will give you some money in your INR, in your NRO bank account. So this is as good as a gift. Avoid these kind of transactions. Third is about PPF and Sukanya Samriddhi. So if you have opened this PPF account as a resident, and then you became NRI, what you can do is you can continue to hold, you can continue to deposit, you can continue to take the advantage till its maturity. If it is matured and you are a non-resident Indian, you have to close that account, take the proceeds to NRO. You cannot request for the extension of another 3 years what you get. And also, as a non-resident Indian, you cannot open a new PPF account. And last point being, as a non-resident Indian, FEMA prohibits you in acquisition of an agricultural land. So as a NRI, you cannot buy an agricultural land. Only exception for you to buy an agricultural land is through inheritance and nothing else. Okay. So these were the things which I wanted to quickly rush through. Given the time frame, I have tried to cover most of the points. So you can visit my website. I have been writing a lot of articles and blog. National media houses have been covering. So whatever articles I write, I publish on this website, ca4nri.com, and you can visit this website and read up on the articles and blogs that I have been publishing.
This has been a heartfelt thank you to CA Ajay Vaswani for taking time to demystify the complex subject of Indian taxation for NRIs in the US. Your explanation has certainly left us more informed and confident about the Indian tax matters, sir. We would also like to extend our sincere thanks to HDFC Life, especially Mr. Shiminder ji for their continued partnership and support in empowering NRI community through the financial awareness. And we once again wish you a great day and a great year ahead, Mr. Vaswani. And thanks to all our participants. We hope today's session would have been useful to you in tax planning and compliance from India point of view. And if you have any further questions or would you like a personalized guidance, our NRI Well Plus team at Integrated is always just a WhatsApp away. Just until next time, stay informed and stay invested. And thank you all once again. Have a great weekend. Thank you.
Thank you so much,
Thanks
everyone.
a lot, Mr.
It
Ajay.
was a
Thanks a lot,
delight.
Mr.
Thank
Shiminder ji.
you all for the wishes. And my start of the day is very good for this matter.